Our topic today is going to focus around year-end tax planning. I'm joined today by Baird's tax strategist, Kelsey Clare, who will summarize the 2022 changes and look ahead to legislation that could be enacted after these midterm elections. She will also spend time discussing a variety of planning strategies for you as clients to consider ways to manage your tax liability at year-end. For those of you unfamiliar with Kelsey joined Baird in 2020, and prior to joining Baird, she was responsible for providing tax compliance and tax planning services to high net worth individuals and privately held businesses. She graduated from the University of South Carolina with both a bachelor's and master's degree in accountancy with a focus in taxation. Kelsey is a certified public accountant with the North Carolina State Board of Certified Public Accountant Examiners. So before I turn the call over to her, I do have a few housekeeping items that I'd like to highlight. For optimal viewing, we would suggest setting your layout to the side-by-side view via the circle in the upper right-hand corner of your screen. All participants are in a listen-only mode, but we would love to hear from you. So we will host a Q&A session at the end of today's webinar to address as many questions as time permits. You can submit a question by clicking on the Q&A icon on the bottom right-hand side of your screen. Just please be sure that you are addressing your questions to all panelists. This presentation is being recorded and will be made available along with the slide deck about a week following today's presentation. You can obtain a copy through your Baird financial advisor or via bairdwealth.com. So with that, thank you everyone for joining us today. Thank you, Kelsey, for being here. I will now turn it over to you.
Great. Thanks, Justine, and thanks everyone for joining us this afternoon or morning for some of you. Again, I'm Kelsey Clare, one of the tax strategists here at Baird. I do have a lot of information to cover, so I am going to jump right into it. But I do like to begin, every year-end tax planning discussion with just a reminder that, while taxes are very important and have a large impact, they should not be the driver when making investment decisions. So these decisions really should be based on the investment merits first, with taxes being a secondary issue. So I'm going to start off by briefly touching on, what tax law changes expired at the end of 2021. These are mostly benefits that existed for 2021, but that we will not see on the 2022 tax returns. We'll also run through some of the tax changes we could see, maybe in the coming months, specifically those that will likely be discussed in the lame duck session coming up. And then we'll go over some year-end planning strategies that might be helpful from a tax perspective. So what went away? A lot of changes and enhancements were introduced in the various relief bills that passed over the last 2.5 years or so, and those were in response to the COVID pandemic. There was the provision that probably got the most attention was the recovery rebate credits. They were also known as the economic stimulus payments. Now, although these were technically credits, you probably remember that these were sent out shortly after each bill was passed, and that was really just to get money into American hands as quickly as possible. Now, if an individual or household was eligible for more than what they received, they could claim it on their 2020 and 2021 tax return. Now, that was $1,400 for 2021. For 2022, there are no recovery rebate credits, so you won't be seeing that anywhere on the tax returns. The Child Tax Credit Enhancement, so that was included in the American Rescue Plan Act, or some people call it ARPA. And it increased the credit from the original $2,000 to $3,000 for children age 17 or younger. Now, those under age 6 did qualify for a little bit more. It was a $3,600 credit, and those credits phased out based on your income level. For 2022, under current law, that credit amount is back to the $2,000 per child up to age 16. There were an enhancement to the child and dependent care credit that was also introduced in ARPA, and it increased both the credit percentage as well as the amount of eligible expenses on which the credit is calculated. Now, these enhancements expired at the end of 2021. So for 2022, we're looking again at a max credit of 35%, and the maximum qualified expenses being $3,000 for one dependent, $6,000 for two or more dependents. The dependent care FSA, we saw the amount that an employee could defer from their salary tax-free to cover those dependent care expenses. That was increased from $5,000 to $10,500 for 2021 only. Now, employers were not required to increase that amount, so they would have had to adopt that increased limitation. But now that we're in 2022, we're back to a maximum of $5,000, and that's per household. So a married couple can only defer a combined amount of $5,000 between the two of them. The FSA grace period. So with FSAs, it's a use it or lose it. So assuming the employer adopts this, you usually have 2.5 months after year end to utilize those funds before you lose it. However, in the past 2 years, that was extended to 12 months, and that was in the Consolidated Appropriations Act. And again, that was at the employer's discretion, so they didn't have to adopt this extended period of time. But for 2022, that rule doesn't apply anymore. So assuming your employer has adopted this, grace period, we're back to a March 15th, 2023 deadline for the 2022 balance. Charitable contributions, so charitable deductions. We had two kind of big new rules the past couple of years. We had, this standard deduction for qualifying cash contributions. For 2021, that was $300 or $600 if you filed jointly. That was basically just an additional deduction for those that took the standard deduction. Now, we also had this 100% AGI limitation on qualifying cash contributions. That applied only if you were itemizing your return on your return. That went away. We're back to a 60% limitation on those cash contributions. All right, so election day was yesterday. We're still kind of seeing the workouts of that, but we do expect to see an active lame duck session in the coming months. Given the two legislation proposals issued earlier this year, we expect that a lot of the discussion topics are going to revolve around retirement changes. There were two big bills: the Securing a Strong Retirement Act, which is also dubbed the Secure Act 2.0. That was the House's version of the bill. Then there was the EARN Act and the Rise and Shine Act. That was the Senate's version of the bill. These were both just in proposal form, so nothing was passed here. But the two bills had a lot of similarities in them, making us think there's a good chance we could see these coming up. Unrelated to retirement, but an extension of the enhanced child tax credit was a priority for the Democrats, for Biden especially. So we just talked about that, increased credit that could potentially get extended. Other priorities include an increase in the RMD age. So both bills suggested increasing that age to 75 by 2032. An index of the $1,000 IRA catch-up limitation for those age 50 and up, an increase in the catch-up limit on qualified employer retirement plans. So right now we have a $6,500 catch-up for those age 50 and up. It's actually $7,500 for year 2023, but both bills aim to increase this catch-up to $10,000. Each bill had a kind of a different time frame when this would kick in, but the $10,000 was consistent in both bills. Require catch-up contributions to employer plans be made on an after-tax basis. So right now we can choose how those catch-up contributions are made on a pre-tax or after-tax. This would essentially require them be made on an after-tax basis. Reduce the penalty for not taking RMDs from 50% to 25%, and that could potentially even be lowered to 10% if corrected in a timely manner. Index $100,000 QCD limitation for inflation. allow after-tax Roth contributions to SEP and simple IRAs. Right now, those are only allowed on a pre-tax basis. And allow employer retirement plan contributions to be made on an after-tax basis. So those are your, employer matches, profit sharing. Those are currently made on a pre-tax basis. So this would essentially allow employees to elect to treat those as after-tax contributions. Now, all these I've just listed here, these are all changes that were listed in both the House's version and the Senate's version of a retirement bill. So it is possible we see some of these come into play. All right, now that we've talked about legislation, I do want to switch gears and discuss some key concepts around year-end tax planning. So, we're less than 2 months away from year-end. There's just kind of a little bit of time left to make some changes or initiate any strategies you think might be worthwhile. But first, I do like to go back to the basics and kind of discuss the different types of income. So generally, when you're considering income tax implications or when you're looking at a 1040, there's two main categories you need to be familiar with. That's the ordinary income items. That's listed here on the left-hand side. That's your wages, self-employment income, interest, non-qualified dividends, IRA distributions. So that's the ordinary income bucket. Then we have the capital gain income bucket, and that's usually generated when you sell a capital asset. So those stocks, bonds, mutual funds, or when you sell a primary residence, for example. That also includes qualified dividends and capital gain distributions, which you'll see listed on your consolidated 1099s issued shortly after year end. And then those capital gains are broken out into two buckets. So we have short term, which are those held for 1 year or less. Those are taxed like ordinary income at our ordinary income tax rates. And our long term are those held for more than 1 year. So these and qualified dividends are taxed at the preferential rate. That's 0, 15, and 20% based on income level. Here you can see the 2022 tax rates for a single filer. Our ordinary income is taxed at a progressive rate. So, when someone says you're in a 32% tax bracket, that doesn't mean all of your income is taxed at 32%. A portion is going to be taxed at 10, 12, 22, 24, and only the amount over that lower threshold is taxed at that 32% tax rate. Now, our qualified dividends and long-term capital gains, those are taxed on a progressive rate as well, but they are stacked on top of ordinary income. And that means your last dollar of ordinary income determines what tax rate your first dollar of qualified dividends, long-term capital gains are going to be taxed at. So this type of income here is taxed at a 0, 15, or 20% tax rate. And again, that depends on your income level. And here's the brackets for a couple filing jointly for 2022. So through the 32% bracket, you can see that they're pretty much double the amounts for a single filer. But the 35 and the 37% brackets are a little bit more compressed. All right, payroll taxes. So these payroll taxes have to be paid on your earned income. So typically your wages, your self-employment income, and they're broken out into, I say, 3 buckets. So we have a 12.4% Social Security tax, a 2.9% Medicare tax, and a 0.9% additional Medicare tax. That applies when your earned income exceeds $200,000 for a single filer, $250,000 for a joint filer. Now, these taxes are split evenly between the employer and the employee, not including that 0.9% additional Medicare tax. That's 100% paid by the employee. Employers are technically, though, required to withhold that additional 0.9% once wages exceed $200,000. So because married filers ultimately don't have to pay this until wages exceed $250,000, they may actually get a small refund due to this additional amount withheld. There's also the Social Security wage cap, where only the first $147,000 in wages is subject to that 12.4% Social Security tax. That is a 2022 number, So it is adjusted for inflation annually. Now, if we look at this visual here, you'll see that for a single taxpayer, the first $147,000 in wages, that's subject to the 12.4% Social Security tax, as well as the 2.9% Medicare tax. And that's split evenly between the employer and the employee. The next 53,000, so that's the 200 less the 147, that's subject to the 2.9% Medicare tax, but only the amount over 200,000 is subject to that 0.9% additional Medicare tax. That brings you to a total of 2.35% on the employee side. Now, if you're self-employed, so these are your independent contractors, those that typically get a 1099, you're considered both the employee and the employer. So you're responsible for both sides of that tax. This is also considered the self-employment tax. All right, well, if we jump into some strategies here. So tax loss harvesting, this is a common tax planning tool where you're essentially recognizing losses with the intention of offsetting gains. Now, this is especially beneficial when you have short-term capital gains to offset because those are taxed at your ordinary tax rates, which are higher. Now, when utilizing this strategy, we need to keep in mind the netting rules. So that's short-term capital losses are going to first offset short-term capital gains. Long-term capital losses going to offset long-term capital gains. And then a net loss in either category can offset gains in the other category. So if we look at an example, Joe and Mary have $5,000 in long-term capital gain and $3,000 in short-term capital gain. To offset some of these gains, they realize a long-term capital loss of $3,000. Now, if we utilize the netting rules, the long-term capital loss is going to first offset the long-term capital gain before they can offset any short-term capital gain. So the full $3,000 is offsetting the $5,000 of long-term capital gain. That leaves us with a net $3,000 short-term capital gain that's taxed at our ordinary tax rates and a $2,000 long-term capital gain that's taxed at our preferential rates. If you do have an overall net loss, you up to $3,000 of that can offset your ordinary income. Any unused portion can then be carried forward indefinitely and be used in a future year. We need to be aware of the rules. So this rule disallows the recognition of a capital loss if a substantially identical position is purchased 30 days before or 30 days after the sale. Now that creates a 61-day window, including the date of the sale, where you cannot purchase a substantially identical security. So if we look in this at this illustration here, an individual could purchase an identical security either before September 10th or after November 9th and still claim the tax loss for that October 10th sale. Now, clients that are, within this 61-day window or really 31-day window, if you just sold a security, you might consider purchasing another company with similar exposure or within the same industry. So just as an example, sell Amazon, buy eBay, just a way to kind of work it without coming afoul of the wash sale rule. The rule doesn't apply to any sales for a gain, only to losses. So you sell, realize a gain, then you repurchase the next day. You don't defer the gain. IRS still wants your money on that gain, so no impact there. Now, if you do happen to purchase a substantially identical security within this period, the loss isn't necessarily lost forever. If they are both within a taxable account, that loss is going to be added to the basis of the newly purchased stock. That's really just going to decrease the gain or increase the loss upon the later sale when that stock is ultimately sold. One thing I like to call out is the wash sale rule is triggered if a loss is realized in a taxable account and the asset is repurchased in an IRA within 30 days. So even though it's not the same account or technically the same owner, because the IRA owns the other one, that it does still trigger a wash sale rule. All right, Roth conversion. So this is the process of converting pre-tax into after-tax dollars. So not only does this allow those dollars to continue growing tax-free, but it also reduces future RMD amounts since there are no RMDs on Roth IRAs, at least during the owner's lifetime. From an income tax perspective, conversions are best done when you're in a comparatively lower tax bracket and when you expect higher tax rates in the future upon retirement. That's not the only factor. So you'll want to also consider how long will the assets remain in the Roth IRA. They're usually more effective when the funds are left in the account for a lot of years, allowing them more time to grow. How will the conversion liability be paid? Will it be paid with the IRA itself or with outside funds? Will the IRA be used during your lifetime? How will that impact your heirs? So unlike traditional accounts, qualified distributions from Roth IRAs, including inherited Roth IRAs, are tax-free. So that might be really beneficial if your heirs are in those higher tax brackets. We do see a lot of clients, post-retirement, so in their 60s doing Roth conversions. Keep in mind that Roth conversions do impact your Medicare premiums or Social Security taxation because that conversion amount is included in income for those specific calculations. All right, so jumping to charitable contributions. So 2022, we're back to the normal rules. We don't get those additional benefits I mentioned earlier, and you only get a benefit if you itemize your deductions. And essentially, to itemize the sum of your deductible medical expenses, state and local taxes, mortgage interest, investment interest, charitable contributions, those all have to exceed these standard deduction amounts. So that's $12,950 for a single filer, $25,900 for a joint filer. Those amounts don't include the catch-up amounts for those age 65 and up. There are different AGI limitations based on the type of property donated and to which type of property or charity. So cash gifts to public charities or donor advised funds sponsoring public charities, those are subject to a 60% AGI limit. When you do those to private foundations, that drops down to a 30% limitation. Gifts of appreciated long-term securities, those are subject to a 30% if given to a public charity or donor advised fund, and it drops down to 20% when giving to a private charity. And any unused charitable deduction due to these AGI limits can be carried forward for up to 5 years. They will be subject to the same AGI limitations in those later years. Stock donations. We like stock donations because not only do you get a deduction, but you avoid the capital gain recognition that you would have recognized if you sold it and then donated the cash. The value of the deduction depends on if it's short-term or long-term in nature. So donations of long-term appreciated securities, the deduction is going to equal your fair market value using an average of the high and low on the date of the gift. With short-term appreciated securities, the deduction is limited to your cost basis, so you do lose out on any appreciation there. You don't get any benefit on that. And then we do advise individuals to avoid donations of depreciated securities because you'll essentially lose the loss there. Instead, you should sell the stock, claim the loss, and then donate the cash. Qualified charitable distribution. So these are distributions from an IRA paid directly to a qualified charity. Keep in mind, QCDs cannot be made to a donor advised fund. So that's something that has caused confusion in the past. So it has to go directly to the charity itself. To utilize this, you have to be at least 70 and a half at the time of the gift. The maximum amount you can do is $100,000 per year. That's per IRA owner. And it can count towards your RMD. So it can satisfy your RMD, and it can be used with inherited IRAs as well, as long as the beneficiary is at least 70 and a half at the time of the gift. You can't deduct these as charitable contributions, like as an itemized deduction, but the distribution is not included in AGI or taxable income, which allows individuals to qualify for other tax benefits and avoid higher Medicare premiums. Now, I think this is goes a long way just to show it with an example. So let's assume Mary and Joe received $35,000 in Social Security benefits and $14,000 in other income. Now they want to use $50,000 in their IRA to donate to a charity. If we utilize a QCD, the distribution is not going to be taxable. Their provisional income, which is the metric used for Social Security taxation, that's going to be $31,500, which is below the minimum threshold. And therefore, none of their Social Security benefits are taxed, and they have a zero tax liability. Now, instead, if they take the $50,000 IRA distribution and then donate the cash to charity, the distribution would be taxable. They'll get to claim it as an itemized deduction, but the provisional income jumps up to $81,500, causing $85,000 of their benefits to be taxed. That means their liability is going to be $48,39. So you can see that, the charity is receiving the exact same amount, but utilizing the QCD allows about $5,000 in tax savings. Bunching of itemized deductions. This one can go a long way. So this is when you accelerate or defer expenses into a single year to maximize your deductions. It's easiest to do with charitable contributions because that's really what you have most control over when it's paid. But it can be utilized with other items like, taxes. If you're not hitting the 10,000 cap, mortgage interest, if you want to maybe try and accelerate your January payment, for example. But definitely charity is the easiest way to go here. Now, for it to work, you have to move between the standard and the itemized deduction. And you can see here, these are the standard deductions and the additional amounts for age 65 or blind. And as a reminder to itemize, the sum of all those deductions, mortgage interest, property taxes, charitable contributions, those need to all exceed these standard amounts to do so. So you can kind of see how valuable this is once I run through an example. So if we assume Mary and Joe make $6,000 in charitable contributions each year, this, along with their property tax and mortgage interest, yields a deduction of $25,500. That's slightly below the $25,900 standard. So we're using the standard every year. They're not getting the tax benefit for that charity. Now let's assume they bunch the charitable deductions into alternating years. So rather than $6,000 per year, they're doing $12,000 in year 1, again in year 3, and then nothing in year 2 and 4. Now in year 1 and 3, that doubled charitable contribution allows their itemized to be above the standard. In year 2 and 4, they use the standard. That's essentially a freebie. So they're making the same charitable contributions, but by timing it up correctly, their deduction is increased by $11,200. This also works the other way if you itemize every year. So if we assume they contribute $20,000 a year, causing itemized to be above the standard by about $4,000 each year. If they instead bunched these and contributed $40,000 in year 1 and 3, they could itemize in those years and then take the standard in years 2 and 4. As you can see, we're comparing 120,000 deduction to 151,800. That's an additional deduction of 31,000 just by bunching. And this is where a donor advised fund can be super helpful because you do get the deduction in the year you contribute to the donor advised fund. The funds don't ultimately need to go to the charity until you choose them to. Okay, so tax payments. How we pay our tax bill is really important. There are several ways to make payments to your tax account each year. If you overpaid in the prior year, you can apply that overpayment to the current year. You would have had to do that when you filed your prior year's tax return, but it can be done. withhold from your paycheck or other distributions such as an IRA, or you can make quarterly estimated tax payments. So these can be made by either mailing in a check with a payment voucher, or they can be made electronically via the IRS's website. So we have 4 quarterly payments. We have a first quarter payment that's due April 15th, second is due June 15th, third is due September 15th, and the fourth is due January 15th following year. Now, the timing of these payments is really important as well, since the IRS essentially want you to pay your taxes as you earn the money. So, even though the amount, when it comes to withholding, even though the amount you withhold throughout the year might fluctuate based on, your withholding elections, the IRS does treat the as if it was made evenly throughout the year. So if I had 100,000 in withholding at the end of the year, IRS is going to assume that 25,000 of that was withheld each quarter. Now, estimated tax payments are a little different. They have a specific date tied to it. So if I make a third quarter estimate on September 10th, the IRS is going to treat that payment as being made on September 10th. So I mentioned timing because this does directly impact whether or not you're assessed an underpayment of estimated tax penalty. To avoid this penalty, you have to pay in a minimum amount of taxes throughout the year, but also at the right cadence. So in total, your payments have to equal the lesser of 90% of your current year tax. So that's 2022 in this case. That's obviously a little hard to estimate because, the year hasn't ended. More things can come in. Capital gain distributions are a big one. And there's always, some lingering items that you might have forgotten about until you get that tax form after year end. So this one's a little more difficult to calculate. And that's why a lot of people use what's called the safe harbor amount. And that's 100% of your prior year tax. Now, if your AGI exceeds 150,000, that percentage jumps up to 110%. Now, the IRS, they want you to pay in one of these thresholds, but they also expect you to pay your taxes as you earn it. So even if you paid in these minimum amounts, it's still possible to be assessed an underpayment of estimated tax penalty. Now, for example, if you make an estimated tax payment for your full liability at the end of the year, you're technically underpaid for the first, second, and third quarter, assuming you had income those quarters, and therefore you'll likely be assessed a penalty. So you want to really be sure you work with your tax preparer to ensure you're paying in enough and at the right time. You'll also want to be sure you have enough liquidity to cover your remaining liability in April when tax filings are ultimately due. Now, for state purposes, the state income tax payment requirements, they vary by state. Some do follow the same rules or very similar rules, but some are different. So you'll want to be sure you check your state requirements. And one question I get a lot is how the different agencies work together. So if I'm due a refund for federal purposes, but I have a balance due with my state return, the federal government isn't going to send a check to the state. I have to physically write a check separately to the state, and then I'll get my refund from federal, but they don't send money to each other. So you'll have to treat them as two separate entities. All right, so I wanted to just touch on, some items that impact a lot of us, especially as of late. So the housing market obviously exploded this year. A lot of individuals took advantage of the high prices and they sold their homes. A lot of times people think their total gain is actually larger than it really is because they haven't properly adjusted their cost basis in the home. So your cost basis, it's going to include your original purchase price, plus certain settlement fees paid at that time. So if you try to dig up your original settlement statement, settlement sheet, or the HUD one, it's also called, it should have the details on there. But then you can also increase your cost basis by any renovations or improvements made to the home. So just make sure you keep documentation for all those improvements. Now, after you've adjusted your cost basis, the amount by which the sales price exceeds that is going to be your your total gain. But if the property is your primary residence, you might be eligible for an added benefit. Now, I get this question a lot. How quickly do I need to roll my sales proceeds into a new residence to defer the gain? But this rollover rule actually expired back in 1997. It was replaced by the capital gains exclusion. So for a single filer, you can exclude up to $250,000 of your capital gain on a primary residence. For joint filers, that amounts $500,000. Now, to be eligible, you have to meet the 2 out of 5 year rule, which basically says you have to have owned and used the property as your principal residence for at least 2 of the preceding 5 years. Those 2 years don't need to be consecutive, but they do have to have happened in the 5 years prior to sale. For joint filers, the only one spouse needs to meet the ownership test, but both of them need to meet the use test to benefit from that full $500,000 exclusion. You can only use this once every 2 years, so there has to be at least 2 years between sale dates for you to use this exclusion again. So kiddie tax is another topic that comes up quite a bit. So this is a tax imposed on children whose unearned income surpasses a specified threshold. The amount over that threshold is taxed at the parent's marginal tax rate, which obviously can be a lot higher than the child's tax rate based on their income level. Now, this tax applies when all of these conditions are met here. So unearned income exceeds $2,300. That's a 2022 number, so it is adjusted annually for inflation. The child meets one of these age requirements listed here. At least one of the parents was alive at the end of the year. The child is required to file a tax return, and the child doesn't file a joint return for the year. So this is really common with, UTMA and UGMA accounts. And it was really created to prevent parents from transferring funds into their children's accounts with the intention of pushing that income into a lower tax bracket. So a small amount might escape the parents' tax rates, but anything over that threshold amount is going to get hit with that higher tax rate. And the last, big topic I wanted to touch on was gift tax. So, there's a few important figures to keep in mind when it comes to gift taxes. We're allowed a lifetime gift tax exemption of $12.06 million. That's a 2022 number. That amount actually increased to $12.92 million for 2023, so a pretty big jump. But for 2022, that means that we can gift up to $12.06 million to other individuals during our lifetime and not be subject to a gift tax. Now, this also directly correlates with our estate tax exemption. So the more we use during our lifetime, the less we have to protect our heirs from estate taxes upon our death. We also have an annual gift tax exclusion. That's $16,000 for 2022, $17,000 for 2023. But that essentially means that for 2022, we can gift a single person up to $16,000. And that's not going to count against our lifetime gift tax exemption. So for a married couple, they could give a single person up to $32,000. That's $16,000 a piece. If you are looking to fund a 529 plan for either a child or another individual, there's a strategy called super funding, which applies only to 529 plans. So this is where you can fund up to 5 years worth of gifts in a single year. So if I wanted to super fund a plan in 2022, I could contribute up to $80,000 and it would be treated as though I contributed $16,000 for this year, as well as the next 4 years, thereby avoiding any gift tax implication. It's really a way to just get that money in there as quickly as possible without a gift tax consequence. And lastly, it's important just to know that medical expenses and tuition paid directly to institutions are not considered gifts. Therefore, they don't count towards your annual or lifetime gift tax exclusion. Now, So if you have if you're covering medical expenses for someone, it's much better to pay that institution directly rather than giving them the cash to pay. That way you're kind of circumventing the gift tax rules. All right, knowing your deadlines. So some big deadlines coming up here. Year end December 31st. That is when our 2022 RMDs are due, assuming you turned 72 prior to this year. So make sure you do take those. Employee contributions to qualified retirement plans. That's really typically your salary deferrals. We then have January 17th of 2023. That's the deadline for our 2022 fourth quarter federal estimated tax payment. April 1st of 2023, that's the deadline to take your 2022 RMD if you turn 72 this year. So as a reminder, your first RMD can be delayed until April 1st of the year after you turn 72. If you do delay this first RMD though, you will need to take 2 RMDs that following year. So if I delayed till April 1st of 2023, I would have to take both my 2022 and my 2023 RMD next year, which can hike up your income. April 18th, 2023, tax day. So this is the deadline to contribute to a traditional or Roth IRA, as well as your HSAs for 2022. It's also the deadline to file your 2022 Form 1040 and pay any tax liability, or file an extension with the IRS. As a reminder, the extension, that's just an extension to file. That's not an extension to pay. So you'll want to be sure you're at least projecting what your tax liability is going to be. So you're paying in enough to cover that. And this is also the due date for 2023 first quarter federal estimated tax payments. So again, this is where you kind of go back to those safe harbor amounts, either 90% of current year tax, 100 or 110% of prior year tax. So just make sure you are accounting for that if you don't have enough withholding to cover your tax. All right, next steps. So I'd say, we have a few weeks left of the year, engage your tax advisor to run a year-end tax projection, especially if you think you might be underpaid. Make sure you won't be subject to that underpayment of estimated tax penalty, and just make sure you're looking okay coming for April, and you have enough cash flow to cover that. Also, reach out to your Baird advisor if you think any of these tax strategies could be right for you. They do have a lot of more detail on all these topics that they can send you to, and they can also connect you with someone on our tax planning team, and we can take a deeper dive into your specific situation. And lastly, I'll say refer to bairdwealth.com for any additional resources. So we have literature out there about a lot of different tax planning and year-end strategies, including the ones I talked about today. We'll also have our mailing dates for Baird's 1099s. Those will be updated here shortly, so keep an eye out for that. And then we also have our 2022 tax facts. So this is a document that covers a lot of the big important numbers for 2022. So we're talking tax brackets, benefit thresholds, retirement plan limitations, a lot of good information out there that will really help you as you round out the year from a tax perspective. And that is all I had for you all today. So I know I covered a lot of information. Feel free to throw any questions in the chat box, and I'll try to answer as many as I can. But first, I'm going to pass it back to Justine.
Great. Thank you, Kelsey. I will just take a minute to remind everyone, I'm seeing quite a few questions pop in here, but if you do have a question, you can submit one via the Q&A icon on the bottom right-hand side of your screen. So with that, Kelsey, I will pass it back to you so we can knock some of these out.
Great, thank you. All right. Can you contribute some or all of your RMD to a donor advised fund? So you cannot, and I'm going to assume we're talking about QCDs here, qualified charitable distributions. you can make qualified charitable distributions only directly to charities. So you cannot do a QCD to a donor advised fund. Alternatively, you could take your RMD for the year and then contribute the cash to a donor advised fund, but that RMD is going to be taxable, and then you would have to claim an itemized deduction for the donor advised fund contribution. Could you review a conversion to Roth IRA impact on Medicare and Social Security? So really, a Roth conversion is going to be included in both of those calculations. So for Medicare premium purposes, that Roth IRA is included in the modified adjusted gross income number. So that is oftentimes a big surprise to people when they do utilize those conversions. That could easily cause a jump in your Medicare premiums. Same thing with Social Security. So if your income is really low, you might otherwise not have much of your Social Security benefits taxed, but that Roth conversion can definitely bump you up and cause up to 85% of your Social Security benefits to be taxed. All right. Sorry, some of these are moving around. What is the max Roth conversion annually? There is no limit now to Roth conversion amounts. You can convert as much as you want. There used to be a max Roth conversion amount based on your income levels, but that was eliminated. So we really just have to worry about the Roth contributions now from an income limit perspective. Okay. Does the super funding of the 529 account need to be a new account, or can it be existing? It can be an existing account. There's no need to have a new account. I'd say if you and your spouse were going to contribute those, maximum $80,000 to a 529, I'd almost be inclined to do it to two separate accounts. Although I guess you could technically do gift splitting on a gift tax return to prove that, you're each making it and it's not one person. But yes, generally, if you're super funding in a 529, you can do it to an existing account. Okay. What about inherited IRAs? When do you have to start taking distributions? Can you take it over 10 years, take it out at the end of the 10-year period post-death? So this has gotten a lot of attention as of late. When you're not an eligible designated beneficiary, you generally are subject to the 10-year rule, and the IRS issued some proposed regs recently that indicated that in addition to liquidating the account by 10 years, you also had to take annual RMDs. That has caused a lot of confusion and hysteria, but they did actually put out some additional guidance that seemed to indicate that if someone died in 2020, you had RMDs technically under this new legislation for 2021 and 2022, that those did not need to be taken. So they did say that you would not be penalized if you did not take those annual RMDs based on this new interpretation of the 10-year rule. But what we don't know is if they're going to require you to essentially catch up on those distributions. So in 2023, do you have to take 2021 and 2022? So we're still waiting on some more guidance there, but we are supposed to get some more information hopefully by the end of the year. Is there a particular income or deduction scenario or combination that is more beneficial for bunching deductions? Charitable contributions are where you have the most flexibility just because you have quite a bit of control over when those are made. Regarding, how much income is where you get the most benefit. I mean, it's just, I'd say ordinary income is what you want to offset. That's the biggest perk. Luckily, itemized deductions do offset ordinary income before qualified dividends and long-term capital gains. So I wouldn't say that there's necessarily a certain income threshold that makes the bunching strategy more effective than the other than the fact that, if you're in a 37% tax bracket, those deductions are going to be more valuable than someone in a 24% bracket. So, but in terms of what type of deductions, I'd say charity is your easiest avenue there. Okay, backdoor Roth. Looks like a lot of people are concerned just about its availability in general. So we can still do the backdoor Roth. With the nothing has changed, from a tax law perspective. So basically, just for those that are not familiar, a backdoor Roth strategy is when your income is too high to make a direct contribution to a Roth IRA. So you can essentially do it with the backdoor method. And that's by making a non-deductible traditional IRA contribution. Non-deductible meaning when you fill out your tax return, you don't claim a deduction for it, and then converting that amount over to a Roth IRA. Now, these haven't gone away, so you can still utilize them. If you want the conversion, though, to be effective for 2022, the contribution and the subsequent conversion need to happen by year end. So that's something to keep in mind, especially if you are planning to roll in funds. So if you have like maybe a 401k that you're planning to roll into a traditional IRA that has a bunch of pre-tax assets, you'll want to make sure you do a backdoor Roth by year end of this year if you're going to do that next year. Because when you're doing the backdoor Roth conversion strategy, you're using a year-end balance. So you want the year-end balance that doesn't have any pre-tax dollars in it. So that's just an important distinction there. Is it still the case that gambling losses are now an itemized deduction? Yeah, so gambling losses are allowed as an itemized deduction, but only to the extent you have gambling winnings, which are typically reported to you on a W-2G. But those are still deductible. What if I haven't paid any estimated taxes year to date? I'd first, consult with your CPA, try to get a projection of your 2022 taxes. You might have enough withholding to cover any, safe harbor amounts or to avoid that underpayment of estimated tax penalty. If you don't have enough withholding, I've seen people, take large distributions from, a retirement account and have the trustee essentially just send it all to the government. So that way the withholding is treated as being paid evenly throughout the year to avoid that underpayment penalty. But if your withholding does not cover your taxes, I would try to get your CPA to run a projection and pay in an estimate as soon as you can. I think I've covered Yeah, I think I've covered most of the general ones. I'd say if there are other ones that are very specific, please reach out to your Baird advisor, and we can get in. He or she can get in touch with us to kind of go into more details. But I think we covered most of the questions I'm seeing here.
Great. Thank you so much, Kelsey. We appreciate all of your comments and candor today. I hope everyone on the line has learned something from this presentation. I do still see a lot of questions coming in, so I would just say, I'll reiterate what Kelsey mentioned. Go to your Baird financial advisor with any specifics that you have. Feel free to loop them in. They'll pull in the appropriate tax resources we have on our side to get any of those follow-up questions answered. And as a reminder, we did record today's presentation, and the slides will be available for all of you in the coming week. So keep an eye out for those or reach out to your Baird financial advisor. Otherwise, they'll be posted on bairdwealth.com. But Kelsey, thank you again so much. And thank you again to our audience for being here today. Really appreciate it.